All right, next one up here. Markets will rally into year end and potentially be strong next year too.
Sylvia Jablonski. She's CEO and Chief Investment Officer of Defiance ETFs. And Sylvia, I know this isn't what you were planning on talking about this morning. Welcome to live television. How concerned are you about this report out of Ukraine? We're looking at a reaction this morning of the markets down. It was a big drop down when this report came out, but you were still talking about a decline of less than 0.6% for the Dow and even less on a percentage basis for the other major averages. What are you thinking?
Good morning, Becky. Well, it's never good to wake up to this news, but I think this has always been the caveat on what could potentially hamper a markets rally going into year end or even going forward. We have essentially two wars going on, two major wars that we're well aware of and monitoring, and escalations tend to lead to market pullbacks. And so what I would say is what I see so far is a muted reaction to this, as compared to what we've seen with some of the attacks in Israel, for example, where you see NASDAQ off 300, 400, 500 points or so. So perhaps the market at this point is muted and digesting the information. But, how it escalates, we have a switch of presidents coming into office, and, kind of where this all goes is up in the air right now.
Yeah. Having said that, we have a new administration coming in. You have the market that has been pretty enthusiastic about the potential for this new administration, but still a lot of questions on the details of how things are going to work. There were a lot of promises made during the election cycle. And there's been a lot of commentary, some written pieces recently just digging into the idea that these are not all promises that are going to be able to be delivered if you're looking at the math. You made promises to the wealthy class. You made promises to average Americans. How does this play out? And I guess, what do you think about where we've come so far just in terms of the market's enthusiasm and what can be delivered?
Yeah, sure. So I think that, where we've come in the markets is very much due to the macro backdrop, right? We have strong jobs. We have wages that have been steady and increasing, a consumer that's been spending, a lot of stability essentially in macroeconomics, GDP to 2 to 3%, rates coming down, supportive Fed put. And so I thought, regardless of the election, the market should do well. The market should rally into year end. Corporate earnings are holding up. Projections for next year are high single digits, low double digits. Everything is sort of rosy, soft landing, roaring 2020s. And so what the market doesn't like, though, is uncertainty. And as you said, we don't know which policies actually get passed. We don't know what happens with tariffs. We won't know what happens with immigration. Those two things can affect supply, which can affect inflation. But then again, deregulation and tax cuts can lead to potentially the opposite happening. So it could be a net zero. So it remains to be seen what actually passes here. But I think overall deregulation, cutting taxes tends to be good for markets. And the path of the Fed matters a lot, right? So as long as inflation doesn't creep back up and the Fed's kind of steadily reduces rates, I think we'll be okay. And I think the market rallies into year end. And I mean, we're almost there anyway. And it's, kind of rallied in minus this pullback, but potentially a strong year next year as well.
I think the biggest question maybe is, do earnings keep up with some of this enthusiasm? We have lots of, as you mentioned, enthusiasm that is tied to deregulation and lower tax rates, and that's clearly a plus for business forces being unleashed. But you also have markets that have risen pretty substantially. Everything looks great, but there's always a price. And what's the price? So where do you think, just about where stocks stand in valuation terms at this point?
Yeah, I mean, valuations are high, but earnings has thus far justified those valuations. And so I think what happens is if you actually get the tax cuts and you actually get the deregulation and rates keep coming down, that is undoubtedly a tailwind for corporate earnings going forward. And I think that keeps up with the rally. In terms of when it exhausts, I think that there will be an end in sight, but probably not in the near term here. So the other thing that I think investors can do, though, is broaden out their exposure, right? So the overvaluation comes from the top 33% of the S&P 500, which is really the Mag 7. And so if you broaden out to the other 493 names and, kind of look at the X-Mag, the names that are hidden in there, like the Constellation Energies, the Vistras, the GE Vernovas, the Palantirs. I mean, there's a lot of places to put your money that kind of aren't overvalued at this point.
So the thing I didn't like about that right there is she kind of frames it, and I've seen a lot of people frame this as like overvaluation in the Mag 7, right? Not really. Microsoft's actually attractively valued right now. Meta's insanely attractively valued right now. Look at the forward P on the stock and look at the growth rates, and you'll be able to understand, oh my gosh, like Meta's a steal deal here. Amazon's undervalued right now in this market, right? So I just ran you through 3 of the Mag 7s that are actually undervalued. NVIDIA, you could make a strong case that that stock's even undervalued here, and that stock should be more priced in the 150 to 200 range, right? So now I just made a case for 4 of those stocks. Tesla always trades rich. That's Tesla. Apple, you can make an argument that's maybe a little overvalued, and Google, you can make an argument that it's undervalued, but they are going through a lot of government-related stuff and potential disruptions in their business model, so there's a lot of questions there, but you could make a decent argument that Google's undervalued as well, right? So I think 5 of the stocks you can make arguments that are undervalued right now, and I think only 2 you could really argue that, are maybe overvalued right now, right? So that takes care of that. Now, there are tremendous opportunities all over this market, but those opportunities are really in a lot of the dividend stocks and value stocks, a lot of the beaten down dogs that no one wants right now, right? That they'll start to come back to in 2025, and then they'll come back to even on a greater extent in 2026, right? But that's going to be something that plays out. So as far as where I'm putting money right now, like I did a video, I believe it was last night on the main channel. If you don't follow me on my main channel, Financial Education, right? Discussing the 5 of the best opportunities I see as far as stocks to buy here into year end, right? And I went through those 5 stocks and why those 5 stocks are tremendous opportunities right now. So yeah, there's definitely opportunities in this market. Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you looking at in front of you right there? That's the 6-figure Hall of Fame. Do you want to see the next one? That's the 7-figure Hall of Fame. Now, that is my private group. Those are members of my private group that have scaled to 6 figures, multi-6 figures, 7 figures, multi-7 figures in their stock market portfolio. They say you are the average of the 5 people you associate with. If you're somebody that is having trouble finding other long-term investors that are focused on building their wealth over the coming years, finding like-minded folks, look no further than my private group. We got a tremendous amount of people. We're consistently talking with each other, learning from each other, researching companies together, sharing news about our different companies, right? We do all that inside my private group. If you would like to apply to join us in there, go down in the description area. There'll be an application down there. You can click on that and you can apply to join us in there and take your game up to a much higher level and associate with the type of folks that you actually want to associate with. Now, additionally, when you look below that Mag 7, you have other big tech companies that are very large companies, but they're not like that level of large, where we're talking like $1 trillion plus type companies, right? AMD is a good example of that. AMD is usually, a $200-something billion market cap, so it's a big tech company, but it's not like those sorts of big tech companies, right? And I did a video, a day ago or 2 days ago, right? 5 stocks to buy within 30 days. Insane gains coming. And guess what the first stock I featured in that video was, of those 5 stocks? It was AMD. AMD is looking very undervalued. So you have some of these other big tech stocks that aren't technically Mag 7s, but are actually trading very undervalued. I think people that buy AMD stock over this next 30 to 60 days, I think they're going to look back 1, 2, 3 years from now and be very happy they did so. And I mean very happy, and that's why it was the first stock I featured in that particular video. So that's another thing to keep in mind there. Palantir. Listen, Palantir. It might have one final move in it for 2024. And I thought the move in regards to Palantir was done until I heard about the NASDAQ listing. And right, the NASDAQ, the addition there, right, next week. And then the decent probability is going to get into the QQQ, and then it's going to probably be a top 35, if not a top 30 stock in the Qs. Could put a lot of buying pressure in regards to Palantir at the end of the year. So this one, I know a lot of people have kind of thrown in the casket, they've thrown in the coffin 6 feet deep. I'm just going to be honest with you guys, it might have one last hurrah move here at the end of the year. And that's going to be wild if that does play out. But the way I look at it is getting in the NASDAQ and then likely getting in the Qs. I think it's hard for me not to see that stock kind of have one last hurrah kind of epic move there, right? And it was interesting kind of seeing the bears celebrate over the last, day or two about Palantir stock finally not going up, and I'm just like, what are you guys celebrating? The bears in regards to Palantir, like the stock's up a ridiculous amount, right? I mean, I'm up 667%, like that's ridiculous, right? But the other thing I was kind of thinking is, it would be funny if Palantir had one final move here at the end of the year and went $70, $75 $8, something like that. It would be hilarious because all those bears are already so upset with this stock doing what it's done. It would be hilarious just to see one final hurrah move there, but we'll see. But I'm just saying, like, it might have one final move in it here at the end of the year, right? I don't think if that does have that last hurrah move and goes to 70, 75, I don't think the next 2 to 3 years bode great for gains in Palantir stock, but like, I wouldn't be surprised if it had this one last move here into year end. No, additionally, you have a lot of stocks in kind of that $50 to $100 billion market cap, so we're going to go a leg lower here, that are still very undervalued. PayPal is now a good stock for us, right? Up $69,000 in the public count. And I would say most people that have bought PayPal stock in the last 2 years are now looking very good. And they made a lot of money on the stock, right? But a stock like this, you still look at the valuation of the company and you look at the earnings per share growth, and it's still undervalued stock. So stocks like this, they're not the boogeyman either. Like, these sorts of companies can still move up as well. So that's something to kind of keep in mind there, right? Now, additionally, you have these sorts of stocks, if we go a leg lower, with these Estee Lauder type companies that maybe are in that $20 billion type market cap range. And these are the sorts of stocks that are actually in a bottoming phase right now. These stocks have been leveled. They got selling pressure on selling pressure on selling pressure on selling pressure on them. It was relentless for a long time. But it's very, very clear that these stocks are now in a true bottoming process. And Estee Lauder fits that category. A stock like Nike fits that category, that they've been going through this vicious end-of-year tax loss harvesting. Just everybody that wants to sell is selling these stocks, right? And that's just what's going on with them. But it's a bottoming phase. It's no fun if you're selling the stock. Like I would hate to be a seller of Estee Lauder right now. Like, geez, that stock was what, $370 just a few years ago? I would hate to be selling it at 65. Nike, $73. Oh, I would hate to be a seller here. It's no fun if you're in that selling process. But for people like myself that are now buying these sorts of stocks, like Estee Lauder, Nike, oh my gosh, these are like just give me every share in sight of these stocks right now. Nike's trading a little, $100 billion market cap-ish. Estee Lauder right now trading around a $23 billion market cap. I mean, just this is a historic kind of buying opportunity in regards to a lot of these value and dividend stocks. And I've talked a lot about many of these value and dividend opportunities over the last, I would say, few months in regards to the channel. And yeah, I think if we look out 1, 2, 3 years from now, I think we'll be laughing about the days when these sorts of stocks were trading at these sorts of prices. No different than now we look back 2 years later from the tech bubble crash that we had, right, 2 years ago, and when Meta was less than $100, and now that stock's on its way to $700, and we look back and we laugh and like, geez, like, who wasn't buying that dip? And you think about NVIDIA, it's moved, 1,000% plus in the last 2 years? Geez, like, these sorts of stocks are not going to produce that level of return, so it's important to understand that over the next 2 to 3 years, but they're still going to be phenomenal return profiles, and you got to take advantage of what the market gives you. In 2022, it gave us, the NVIDIAs, the Netflixes, Meta, all those sorts of stocks, right? Shopify, it gave us those at joke prices. Like Shopify was $25 a share. Netflix, and now Shopify is $100 plus a share. Netflix went down to, I believe it was 170. Now the stock's, I believe, 700 plus. Like, it gave us these incredible opportunities. And we got to take advantage of that. Like, if you were in position to take advantage of that, like I was, and maybe some of you guys watching this were, you took advantage. And you grabbed those stocks left and right. That was what the market gave us. We took what the market gave us. Now the market's given us these great dividend value type stocks. You take what the market gives you. It's given me these value and dividend stocks that are great companies at 5, 7, 10-year discounts. I got to take advantage of that. I'm going to take whatever you want to give me, market. I'm here to take it. I'm here to take great assets off your hands at great prices. And I'm getting great pricing on a lot of these companies. And I'm going to take every share off the seller's hands as I possibly can over this next few months here. And that's the bottom line in regards to those. And I think we'll look back 2, 3 years from now and be like, that was smart. That was very, very intelligent. Then you've got a situation like what happened in Elf, right? Where, the short seller comes out and they basically say, the gist of it was inventory doesn't add up in regards to imports, how much Elf is importing versus their revenues, and they basically said that they believe the company's overstating their revenues, which is just a fancy way of saying cooking the books, and you had all that drama today, and it dropped Elf stock all the way down to $102. Stock closed today at $119, but it dropped it in the trading day down to $102 because the short seller said this. Short seller also, from my understanding in the report, said something around the lines of like they're looking to short most or all of their short, they get out of their short position like ASAP, right? Which is Also fascinating, right? Now, ELF is a decent-sized position for me. I'm up 1,534% on in the public count. And so I spent about 15 minutes thinking about this. And here's what I came up with. I said, if ELF lied about revenue, I have two questions. One, why are retailers continuing to give ELF more and more shelf space? Retailers don't just give a bunch more space for the fun of it. You're going to tell me Walmart, Target, all the biggest retailers, Ulta, are all going to keep giving ELF more and more space if it's not selling well? What are you talking about? They're only going to give ELF more space if the sell-through is ridiculous. That's the only way that happens. They're in the business of moving product. Two, I said, why would you want to cover your short right now? If it's true, then the company loses all credibility and stock could fall another 50% plus, right? Why cover your shorts now? Fair question. Why cover the shorts now? Did you see what happened to SMCI? If you believe this is another SMCI type situation, why would you cover your shorts now if you truly believe that, right? I said, also, is Nielsen the most respected company in the world for channel data also making up numbers? Point number 3. So this was in the latest quarter, turning to U.S. Looking at Nielsen track channel data. Nielsen's the big company that tracks all the channel data out there, right? Which represents about half of our business. Our consumption trends in Q2 were softer than expected, coming in at plus 16%. So is Nielsen making up numbers for ELF? This is the number one most respected channel data company. They're just making up ELF, they're up 16%. So Walmart's just making up stuff, and Target's just making up stuff, and Nielsen's just making up stuff, right? I said point 4, international growth is over 90%, while total business growth is at 40%. That means much of the growth is coming from international, and so why would the inventory ever be sent to the U.S.? I said, I spent less than 15 minutes on the subject and just punched holes into their thesis all over the place. That's muddy. I destroyed their thesis in less than 10 minutes. I destroyed it like a piece of Swiss cheese. It's ridiculous, man. These guys, how much time did they spend on this? Like, imagine if I spent like 3 hours on this subject, 5 hours. Imagine if I spent a whole day. I destroyed their whole thesis in less than 15 minutes. But the market does what the market does, right? And I know investors get real upset when this happens, but the bottom line is, if you believe ELF is in no wrongdoing here, right, then, obviously, you view that as a gift, right? $102 on the stock, and then it settles out the day at $119. You view that as a gift, and if anything, you might be wanting to thank those muddy guys over there, okay? Because that's insane, and that's the market for you, right? Now, additionally, and that ELF situation, by the way, that was just a side subject. We're getting back to the whole melt up 2.0 now at this point in time, but I know a lot of people wanted me to cover that ELF subject, so thought I would cover that, okay? Now, back to the melt-up situation, right? What we're looking at now is United States wages and salary growth. Now, we've been kind of in the 6% type range. This matters significantly because CPI right now is in the 2s. There's very little inflation going on out there now at this point in time. The big increases in just, everything going wild. You go to the food store and it's just like, oh my gosh, the price has gone up so much since last month or the month before or something like that. And gas prices, all that's gone bye-bye now at this point in time, right? So we got a CPI in the 2s and we got wages and salary growth at 6% plus. So this sets us up in a phenomenal position for the consumer in 2025. And this is why I view real wages getting to their best position in years or even decades, right? So that's going to bode very, very well, I think, for a lot of these companies that have struggled the last year or two, because it's a lot of them, man. Like I understand the Metas and the Nvidias and those sorts of very, very top tier companies have had great numbers the last 2 years. But those type of companies always have great numbers. They always, when has Meta not had great numbers other than maybe 2022? Meta's always got great numbers. Nvidia's pretty much almost always got great numbers unless they're at the end of a boom cycle in chips, right? Like, those companies are special. Amazon, all those sorts of companies, right? Now, if we talk about the Nikes and the Estee Lauders and all those sorts of companies, they've gone through a lot of trouble in the last year or two. But real wages got destroyed for a lot of folks, right? Really in the back half of 2021, and that ran through all the way into 2023. So real wages got destroyed for about a 2-year span there, and they started to come back here recently in 2024, right? And there's a lag on that to when it starts to really hit. But my opinion is 2025, we're going to see like the best real wage growth that we have seen in years, if not decades, in 2025. Because I'm looking at CPI that's likely going to be coming in twos for the next good amount of time, right? And real wages got to stay there. And do you know why they have to stay there? The reason they have to stay there is because unemployment's still low. Unemployment's in the 4s. If you have an unemployment rate in the 4s, right, and you got CPI in the 2s, there's just no doubt that real wages have to go up quite considerably, which is why we're seeing this sort of wage growth. And so even if we saw, and keep in mind, the wage growth of folks is usually much bigger than, or excuse me, the wages somebody makes are much bigger than what a CPI category would go up over time, right? And so this is going to bode very well for a lot of those consumer brand companies next year, and I think a lot of people are going to start to really understand this in the beginning of 2025, right? Now, additionally, this looks at S&P 500 monthly returns 1928 through 2023. What we're going to find is, if you look at this here, we're going into 2 banger months, right? The December returns on average are around 1.31%, and then January is around 1.16%. And you got Santa Claus rally that usually happens in December, just a very euphoric feeling in the market, right? Earnings season's over, you're not really getting any big economic data. The market can just drift higher, everybody's out there spending. It's just a good vibes, right? And that's why we see so many times the market do very well in December, right? And you get that Santa Claus rally. And then January comes along and you get January optimism. And this year you could have that taken up to another level because we also have a new administration coming in office right in January. So that could lead to even more optimism in January because it's like, oh, we got a new administration coming in. And, just generally speaking, you get that January optimism as well. So that's something to kind of keep in mind there. We're going into 2 banger months. No, I wanted to kind of look at some other data here. And so this one looks at market monthly returns 1980 through 2018. So a little more recent data. And we're going to find December up 1.11% and January up 0.82%. So looking good as far as that goes. And then I said, okay, what about since I've been born? I was born in 1989, right? I'm an 80s baby, barely made it, 1989. And so I said, okay, what about 1989 through 2023? How'd the market do? And what I found was we had 27 up years in that amount of time and 8 down years. And the average return in December was 1.26%. So the moral of the story is, if we want to just kind of look at, since I've been born, it's more than likely than not the market's going higher in December, right? Not a guarantee. You did have 8 down years, but you had 27 up years. So last time I checked, that's what, a 3-to-1 ratio there? 3-to-1 ratio? Now, if we look at January, 21 up years and 14 down years. Average return was 0.41% up. So once again, the odds are stacked in our favor in regards to January as well. So Santa Claus rally could be on deck here with January optimism then coming in, right? Now, additionally, what we're looking at now, you want to pay attention to this red line because that was an open field election year, right? So basically, a lot of times, right before the election, right after the election, you actually can have the market downtrend a bit, which is actually, we had that initial kind of move up, but then, we kind of had a move down here in regards to the market. But what you're going to find is you basically have an epic rally that starts around the last week of November and runs through to the end of December. And it's usually a pretty epic rally. Once again, these are no guarantees that it's going to play out how it usually plays out, but you stack these things together, and sometimes these become a self-fulfilling prophecy. People are like, hey, man, the market usually runs huge. I'm going to buy. And then somebody else looks at it and like, I'm going to buy, and I'm going to buy. And next thing you know, you're in a situation where it becomes a self-fulfilling prophecy because everybody believes the market's going to go higher based upon all the data, Santa Claus rally, January optimism, with all the historical trends. And then it creates the same situation that happens every single year, right? So that's something to kind of keep in mind there. And then you could have fund managers chasing the market into year end, which just adds crazy fuel to the fire. Crazy fuel to the fire. And speaking about more fuel to the fire, oh my gosh. We just surpassed $7 trillion in money market assets. That's insane. If you want to talk about more fuel to the fire, this is insane for 2 reasons, essentially, okay? The first reason this is so insane in regards to money market funds going 7 trillion plus is people will look at this, right? My phone's running low on battery. Thank you for letting me know that. Apple computer? Was that Apple intelligence? The first reason this is huge for the market, the $7 trillion plus on the sideline, is this gives the market a lot more confidence. There's no shortage of money out there. If you get any major drop in the market, you could easily have money come out of those money market funds and into stocks. There's no shortage of money. And I mean no shortage at all. Secondly, if you think about it from this context, right? If you had a bet over the next year, are you likely to make more or less from, let's call it CD accounts, savings accounts, from treasuries, or more? I think that there's a pretty high probability you're going to make less money from those, which if you're making less money from those, what happens? People got to start coming to the stock market to start looking for returns. People start paying attention to value stocks again, dividend stocks again, right? Some of the Mag 7 type stocks again, right? So when we're talking about $7 trillion is over there, that's no shortage of money. And so this is more fuel to the fire for this market here in the short term, right? Additionally, we got to address the elephant in the room. The elephant in the room is Trump won the election and Biden's about to go out, right? Now, the reason that matters is there's a lot of retail investors that did not and refuse to basically invest, especially in any aggressive manner, under the Biden administration. And there's a lot of people, and I can see it. I can see it in the numbers. Since Trump won, there's a lot of people that did not want to invest under Biden, right? And so you just got to understand there's going to be a lot more money coming likely into the market because people are going to feel more confident about investing under Trump than Biden, right? And those people usually have very, very strong feelings. And so this is something that matters significantly.